Hello, everyone. Welcome to the Y-Axis Pod. I am your host, Tristan Yver, and today I have the pleasure of having here with me Mike Cahill, the CEO of Douro Labs, the development team that are behind the Pyth Network. Welcome, Mike.
Thanks, Tristan. Excited to be here.
Yeah, great to have you. I think we've done one of these in a past life, so it's really nice to be able to refresh and talk to you right around this really exciting time. I know there's a lot happening for you guys, for us, for everyone, and so I think it's a good time to have this conversation and kind of dive into some of the stuff here. To get us started, yeah, maybe if you'd like to give a little bit of your background, I actually think it's very fitting for the things you guys are working on now as well, because you have more context than most in crypto would around data and data provision.
Yeah, I've spent over 15 years in trading businesses at pretty much every lens of the market structure. I started in an investment bank doing sales and trade in FX. I then moved to a high-frequency trading firm, and then I went to an exchange, and then I went to Jump Crypto, where we did a whole bunch of trading, as well as sort of some VC investing. And throughout that journey, I've gotten a deep, deep appreciation for how markets work across the spectrum of FX, equities, futures, metals, all of the nuances around things like uncleared margin or clearing, how that changed post 2008 with some of the regulations that went in place. And so it's an area that I'm deeply passionate about, understanding market structure. I think it's incredibly complex, and it requires somebody to sit in many different seats to be able to get it right. And that's what I realized when I left Morgan Stanley. I thought I'm an expert in an FX market structure, and then when I got to KCG, the high frequency trading firm, to build out the market making business, I learned a ton of stuff. For instance, I learned why credit was so important in that market. If you trade something that has a clearing mandate, most of it clears to the DTCC, so futures and equities.
What does clearing mean in this context?
Yeah, so if you're trading in equity, you'll go to the New York Stock Exchange or NASDAQ, and you'll trade it, but everyone has a singular counterparty. It's a central clearing counterparty, CCP, they call them. And in this case, it's the DTCC. And so no matter where you trade, it ends up clearing a singular point, a centralized point. Now, that centralized point is distributed. It's sort of decentralized in that it's owned, or there's members that have to post collateral and post margin. And then they all sort of settle together. And so in order to kind of get into that network, you have to be exposed to one of the clearing members. That works the same for futures. Now, FX doesn't work this way because of the global nature of it, right? There's no singular regulator for the FX market. Obviously, U.S. equities has its own regulator. Futures has its own regulator. It's different, right? There's the CFTC, the SEC. But for something like FX, because it trades in so many different jurisdictions, there's no singular regulator. Can you imagine what the Japanese would say if the US regulator wanted to put in rules on how to trade yen? But yet, if you wanted to run a FX business, you have to be exposed to yen. So in almost every case, you're crossing, by definition, you're crossing into a different regulatory jurisdiction. And so you end up having a very piecemealed network together, but it's also very dynamic. There are different styles of trading venues. There are exchanges that look and feel like equity exchanges. And then there's different flavors of them. Some of the areas where there's competition is on some of the venues, they call them ECNs, electronic communication networks. They will have, let's say, just limit orders. And in those circumstances, you can hit a limit order and you'll immediately get filled. And then there's a different flavor of it where there's quotes, and those quotes tend to have some period of liveness after the requested execution. They call this a last look window. And during that last look window, some of the trades could be decayed or they could be canceled. And that's a nuance you just don't actually see in the equity market. And then complexity, further complexity to this is this lack of clearing means that you've piecemealed it together in a completely different way that involves banks giving credit to one another without a central clearing counterparty. Now, we're getting really into the weeds. There's a thing called continuous link settlement, and that's unnecessary for this conversation. But there are all these kind of important nuances to get right. And so from an outsider, when you look at markets, you don't appreciate this level of complexity. And that was what I learned over these 15 years of doing this and getting exposure to different markets and really digging into them. For instance, when I was at SIBO, it was at a time where the non-deliverable forwards, so restricted currencies, think Brazil, India, Korea, those are currencies where there's a restriction in place by the local government. You can't actually take physical delivery. So those tend to trade on a non-deliverable basis, usually as a forward, and then they cash settle 2 days before settlement. In those markets, the paradigm shifted entirely in 2018. There were these uncleared margin rules, which didn't mandate a central clearing counterparty for them, but effectively made it so that they would have to. Otherwise, it would be impractical to change. And so I led the charge at SIBO FX to build out an NDF business that now is the largest, and SIBO FX has become the largest FX broker or exchange in the world by volume. So anyway, I've been spending a lot of time in market structure for a really long time, and I've been obsessed with the importance of getting market structure right for various markets. And that is why I'm so excited about Pyth and what it has the potential to unleash for new markets. It requires so much detail and so much focus on the nuances of markets and market structure, but it's so worthwhile to do.
Thanks for that intro. Yeah. Actually, what I'm curious to hear after all of those different aspects of the different market structures in the more traditional world is, what was your impression, or perhaps your first impression, of the crypto markets when you came across them and you started participating in them? What were the things that stood out the most to you? I mean, there are things similar to the FX markets, like you have this piecemeal regulation, you're interacting with people all over the world, but it also does have its idiosyncrasies as well.
Yeah, exactly. It's like a really undeveloped FX market. And so the similarities with the FX market is exactly as you say. So there's no specific regulation. But by the way, the FX market is technically unregulated, but generally, if you work at a big institution, you have to be a registered representative, and so the people are regulated. And so that's why that's the way that jurisdictions get around letting people get away with things that's not legal, even though the asset class itself is not regulated. So for instance, you can't do something that would look like collusion, or you can't do something that would look like front running in the FX markets because you're a regulated person. And there's been kind of history of that and precedent. And I think that's actually similar with crypto. We've seen insider trading charges put against some people at Coinbase, and they've been successful. So it's, if you're operating in an asset circumstance, you need to hold yourself to those same rules. And that's what I kind of appreciated. I mean, that's the approach that Jump takes. It assumes that crypto markets need to have the same level of integrity with them. And I think all the large trading firms that have some leg of business within the regulated markets do the same thing. Now, the things where I'd say that we're still sort of in the Stone Age within the crypto markets is just the lack of the ability to net off positions. And this relates to what I referred to, which is the central clearing component. If you put on a trade at NYSE to buy Apple, and then you sell Apple at NASDAQ, because both of those trades are going to settle with the same counterparty, the DTCC, you can net those positions down, right? And so you can buy from one, sell to the other, and you don't need to post collateral. In fact, you get your collateral back. That does not work like that in the crypto markets. If you buy from Binance and you sell to OKEx, neither of those two know about the other's trade. And so you actually have to fully collateralize that position. That's actually the nuance that was in the NDF market that led to the requirement to have central clearing that I was referring to previously. So you would have to collateralize all your positions irrespective of where they traded. And so it's just going to be untenable because some of these positions are gigantic because you got to think they're hedging for like a large oil company who's got exposure in Brazil. They need to put on a giant NDF forward position. And then they need to take it off, and they may take it off with a different bank. And if they had to post collateral to both those banks with having no position on, it would just be a huge drain on the return on equity. So in the crypto markets, you actually have that today. There's no central clearing counterparties. There's no prime brokers either. Prime brokers is what stitches the FX market together and banks. So in that scenario, I think we still have a long way to go for the market structure to evolve. And that was the first thing that I kind of noted when I looked at this market is that it is incredibly fragmented, and as a result requires a tremendous amount of capital, which is a huge barrier to entry for smaller systematic trading firms to be able to really compete.
So to see if I understood correctly, the two pathways to something like this in crypto would be, on one hand, on the decentralized side, there's a protocol that all of the existing protocols decide to integrate that could serve as the central clearing unit, and it could happen in a composable, decentralized fashion. And then on the other side, on the centralized world, there would have to be some hyper-regulated institution or consortium of regulated institutions who would decide to all clear through there instead of individually on their platforms. Is that right?
Yeah, I think you've got it right. And the reluctancy on the centralized exchange side is purely a function of how early that market is. Every exchange is hoping to become the largest exchange, and they don't want to give an inch on their competitors, because if one kind of competitor becomes the largest exchange for clearing, they'll end up becoming the largest exchange for probably trading as well. And there are just areas where it's so competitive as an environment. It's quite clear that it'll change over time. One other area where we've got a big nuance in the crypto markets for traditional markets is around market data. Most crypto exchanges don't charge for market data today. Coinbase is the exception. It does charge for market data. But Binance, OKEx, Bybit, you can actually go and get their API for the most part and consume market data without a license, as far as I'm aware. That looks like equities in the 90s. It looks like FX 10 years ago. Both of those markets have evolved and have very robust market data businesses where they sell their market data. It's incredibly valuable. In fact, it's 20% of the exchange's revenue, $6.5 billion for the large US equity and futures businesses. And so it will eventually come within the crypto markets. It's just a function of, if you're the first to charge for it, maybe people go elsewhere. So you have to strike that balance between growth and profit.
Do you have a sense of what that market looks like on a global scale, if it's that many billion in the US? If you had to guess.
The global
financial data markets.
Yeah, it's difficult to predict. So on the real-time market data side, it's in the tens of billions. And then there's the benchmark market data, which is like S&P 500, the Russell Index. They have different licensing deals, VIX, for instance. And it's an entirely different business. It's not around getting access to real-time market data for trading opportunities. It's more around intellectual property protection. And that's in like the $5 to $10 billion range, I think. So all in, it's somewhere between $10 to $20 billion is probably a pretty conservative estimate. for financial market data in the kind of established market classes. Crypto, again, has the potential to be another huge contributor, when it reaches some maturity.
Yeah, on this note, that's sort of where I wanted to go next. Is this data world that we're speaking of at the moment is all by these centralized institutions through their APIs and whatnot. And from what I understand, what you guys are working on is actually a lot of this, but on the decentralized frontier. What are some of the big differences there, and how is Pyth approaching this as far as data provision to different blockchain protocols?
Yeah, so we'll get into the nuances of how Pyth works. But before we do, I'll just do some very high level framing. So the reason why you pay a lot of money for the NASDAQ feed is because it's executable market data. It allows you to make a trade on NASDAQ. And so there are other things like the SIP feed, which are kind of composites that are not quite as are valuable within the traditional assets or traditional finance world. In the crypto markets, the Oracle feed ends up having the same level of execution tied to it. So when you're building a protocol on a decentralized stack, you can use the composability attributes of blockchains to borrow or use or integrate best-in-class specialists for various components. So for instance, if you wanted to make a great decentralized derivatives exchange, you don't need to first build your own blockchain. You can use someone else's. So let's say that you wanted to use Solana as the fast blockchain. And then if you wanted to use the market data, you don't need to build your own access to market data or even create an entire order book that has the necessary participants such that you don't need another piece of market data. You can actually go get market data from an Oracle like Pyth. And then that allows you and your users to execute at the global price. And you can do that very quickly. And then you can specialize on things like UX. You could specialize in a custom order engine. You can specialize in the way that you're going to calculate and contribute leverage. And you actually end up being able to create a much lower barrier to entry for an explosion of innovation around those attributes, right? And that's where things are so different, because the Oracle price, which gets contributors from all the other markets, as long as it's accurate and fast, it will give a great execution experience to a decentralized exchange without first having to build up all the world's liquidity. And in fact, you can have this, you can even bootstrap having the market makers in the form of having LP participants, and they're the market maker side of things. And it's funny because in AMMs, the LPs generally lose money. There's this impermanent loss or adverse selection. But going back to the FX business, the retail brokers in FX exchanges, they make a ton of money from being the market maker and the LPs because they've got great market data. It's executing at very fast speeds. And that's typically where they make the bulk majority of their money. They call this B booking, and they hold the risk onto retail. It's not that dissimilar to the payment for order flow business, which is very mature. Citadel and Virtu are the largest players in that. And there's not anything nefarious going there. It's just that those trading firms know that on a very short time scale, the average retail trader's trade is going to have no particularly sharp order flow or no immediate impact. When you or I trade, the likelihood that we are right in sub 1 second is very low, right? So it's almost a random walk. And so from a trader's perspective, they actually get to open these positions incredibly cheaply, and they're willing to pay for that because then they can put it into their model, they can determine how they want to hedge it, and effectively they get in net neutral as opposed to paying a spread. So these things, I do predict that over time, the LPs will become a highly profitable component of the decentralized exchange business if you have a great Oracle price. The AMM model does not. It updates only when it's wrong, and it relies on traders to come and take advantage of those LPs. It's a terrible business model for the LPs. And so they have to be subsidized, and they get subsidized by kind of liquidity rewards or inflation. It's very unsustainable. But in like the decentralized derivatives exchange model, it's way more easy to imagine a circumstance where that's going to become a very interesting business to be in and potentially have a very high yields. So a very long-winded way, but the importance of a executable Oracle price on chain is the same as the importance of the Nasdaq's price to being able to trade on the traditional finance or off-chain world.
What was the status quo of on-chain oracles before Pyth entered the market? How were they operating?
It was incredibly generic. It had no focus.
Sorry, what does that mean as far as generic?
Yeah, so the Oracle problem is very broad-based, right? So the Oracle problem is very simply applications on blockchains only have access to that blockchain state. Any other data that needs to be brought in, the price of Bitcoin, the weather, sports scores, all needs to be brought on via an Oracle, some sort of trustworthy way. The definition is oracles update the blockchain state with exogenous data, something from outside, and they have to do that in a trustworthy way. And so that's why oracles focus on trust, right? It needs to be trustworthy. You need to have a system in place. So the first oracles focused on trust in a way that would be generic enough to cover all things. And so the assumption was, well, all data more or less is on the internet. We're going to get data from the internet. We're going to bring it onto blockchains, and then people are going to be able to use that data for who knows what. And it would cover weather data with the same type of model as it would cover financial data. The problem with that is weather data is all free. It's on the internet. You can get it. There's no value really paid to getting highly accurate weather data. It doesn't matter if it's delayed by a second or an hour. It's pretty good. Sports scores also, there's not a huge market for trading sports, but it's a little bit more valuable because there is some, kind of in-game betting, but nowhere near the importance around financial market data. So the approach that these first generation oracles had was, let's go get a bunch of nodes to sit around and watch the internet. And then when we need to publish things, we'll have those nodes who are watching the internet, watching a handful of websites only. They're going to publish them. And we're going to have, let's say, CoinGecko is going to publish the price of Bitcoin. CoinGecko publishes the price of Bitcoin every 30 seconds. We're going to have 10 people, 10 nodes watching that price, and they're all going to publish it. Now, if 2 of them are wrong, well, we've got 8 others that are right. We know which 2 are wrong. We throw those out. We don't even need to average together. Say these ones are wrong. We know that everyone else agreed that the price was this, and they're all reading from the same source. So, these 2 are wrong. So it's a very simplistic model to be able to just get a bunch of people to yell what's going on the internet. So they solved for trust, but they solved for trust at the expense of speed because that took a long time. And it doesn't even acknowledge the fact that by the time the data gets to CoinGecko, it's already been delayed by some magnitude of like 30 to 90 seconds. And so that worked really well for like weather data or sports data. And it's fine. It will work well for that type of data. The problem is blockchains are actually optimized for finance. And so the core utility, at least in my approximation for blockchains, is that it gets to onboard stuff that had never been able to be onboarded on the internet in an application to be brought into finance. That was really the innovation that blockchains and Bitcoin gave us. So This requires an entirely different set of an oracle. It's also the reason why, the world's data is on Google for, kind of curiosities and looking things up. But Wall Street and finance doesn't run on Google Finance. It runs on very specialized market data infrastructure like Bloomberg, which goes and gives you very high access, allows you to pay for specific high premium feeds. And that's what all of Wall Street runs on. So Pyth was designed to go and create a very specialized Bloomberg style oracle that focuses on the nuances of why financial market data is so different than weather data and sports data, and really give the best possible output. And that means focusing on getting the lowest latency data on stream. And there's two ways to cut out latency. The first one is to get access to the data when it's published, right? So you don't rely on something downstream like CoinGecko. You cut it out. You go all the way up. You say, give me access from the source, right? And that source can then publish. And the second thing is to make sure that the source that's publishing it has the legal rights to do so. If you go out and you find somebody that says, hey, I actually have access to the NYSE feed, I'll just republish it to you, they're going to get sued, because that's the business model of NYSE and NASDAQ. They make billions of dollars selling their market data, and it'll be cut off. So we needed to come up with a solution that was going to be future-proof, have a business model so that the sources actually wanted to publish their data, and you can get as close to that T0 time as possible.
That makes a lot of sense. And what I know must have been a challenge, I'm actually curious to hear more about, is how did you get these folks to want to share their precious, precious data? Because I'm sure a lot of these people use the data for their own inferences for whatever they were doing, maybe on the trading side, or they were selling it to other participants at high prices. How did a decentralized sort of protocol go and talk to these giants and get them to want to work and provide this data?
There was a eureka moment. And the eureka moment was all of the revenue, or the majority of the revenue that we talked about for financial market data in the off-chain world, is captured by only a small handful of really large exchanges. Now, if you go and you ask those large exchanges to experiment with a new high-speed oracle that's going to enable competition on blockchains, they're going to slam the door in your face, or they're going to say, sure, we'll do it, but we want 90% of ownership, or we want $1 billion for it. So you can't use them. So you have to find a new source. And this is where the Pyth model ends up being so cool and so innovative. It borrows a page from things like DPIN, or in an off-chain world like Airbnb. So the eureka moment was, upstream from the exchanges, you have traders. And so without traders, obviously on exchanges, there's no market data, because market data, the definition is the prices with which traders want to trade with one another at, or the prices where they just executed. So within the Pyth model, we've gone upstream from the exchange, said, all right, well, why don't we get the trading firms to publish their market data to Pyth directly, not to the exchange, and then from the exchange elsewhere onward. We'll have the trading firms go directly on chain with their market data. This is why it's a little bit like Airbnb. Rather than just having hotels have rooms, well, let's let somebody who owns 5 houses publish them. Now you've increased the supply of places for people to stay. So we were able to find a new source of market data. And there's some amazing elements of it. And this is why I said similar to DPIN, is the trading firms have never monetized this data before by publishing it. Sure, they use it in the analysis of how to run a quantitative trading engine, or to run their quantitative trading strategies. But they've never actually explicitly monetized it. And it's a tremendous amount of money, billions of dollars around financial market data. It's very valuable. And if you can do it in a way where it leads to executions, it's the most valuable component of it. Now, as we already talked about, blockchains require an oracle to be able to run an execution on a decentralized exchange for, say, like a derivatives. And so you end up creating something that's tremendously of value. And so that's what's been the draw for trading firms, is they see this as the very first time they take effectively a found resource. It's something in the basement collecting cobwebs. And Pyth goes to them and says, hey, you know, this, you've got all this stuff. This is very valuable. If you were to publish this on blockchains, man, people, maybe not today, but certainly if things work out, people are gonna pay a lot of money for this. And that was the thing. And what's funny is in the very first pitches of Pyth, the conversation with big trading firms was sub 10 minutes. You start telling them about this idea and the eureka moment gets into their head and their eyes light up. They go, yep, I get it, I'm in. and it was viral. So the first trading firms were some of the biggest ones. And then we had small exchanges like, we want in too. We don't actually make any money from our market data. All the big guys make all the money. We want in. And so the virus of being able to, this idea of being able to monetize data from people who've never been able to do it, contribute to something that is going to be more powerful than any singular entity, more powerful than the market data of just NASDAQ for blockchains, right? NASDAQ's always going to be the most powerful for executing on NASDAQ, but this is for executions on blockchain. So collectively, you get all of these big trading firms, exchange contribute to a universal price, which is what Pyth creates, a universal price for symbols and assets that people get to use. That ends up becoming incredibly powerful. This idea has really snowballed, and we now have gotten almost 100 institutions. These are all institutions, like the largest trading firms in the world, the largest exchanges in the world for crypto. And we even have one of the largest exchanges in the world, SIBO, which actually makes about $500 million a year selling its own market data. They've realized that this has become such a big opportunity, and $500 million for them on the off-chain business is a big business revenue. They said, oh, this is a good opportunity for us to participate in emerging distribution of our market data. We know market data is a big business. We're going to contribute to this. We're not being cannibalistic. We're not doing this in an off-chain world. Only SIBO is going to have the best data to access SIBO markets. But for blockchains, they could be a big contributor. And that's how the idea resonated. And so it's architecturally could not be more different to the first generation of oracles, the chain links of the world. You know, those are sitting out there watching the internet update, 10 people publishing that price at some period of time later, and all these huge delays. It's fine. It's a jack of all trades. It's great if you want to create a predictions market that relies on some very esoteric thing that's on the internet. That's perfect. If you want to focus on financial market data, you need something specialized. And that is what Pyth has been built for. It's highly specialized to be able to bring financial market data on chain.
Okay, so you guys went up all the way to the top of the mountain. You went to where the spring was that was releasing this water at the very, very, very start of this journey. So I understand that part. You got there, you tapped into that spring. Can you walk me through this water's journey from that spring down into the ocean and how Pyth is there at every step of the way?
Yes, and it's a great analogy. So, you know, there's sort of 3 proof points that I'll use to describe the journey. And so proof point number 1 is top of the mountain, amassing those publishers. You know, that's whether or not this idea potentially has legs, right? So you built the supply. Congratulations, you're top of spring. You got to bring that water down to the ocean. So proof point number 2 was, well, how do we get this onto blockchains? Now, Pyth needs to be an oracle for all blockchains. Can't be the oracle for one blockchain, and they all need to have the same access, right? That was a core tenet to being able to build Pyth. You need to have this incredibly big set of symbols updating as fast as possible, the fastest block times in the world, and then make that available to every single blockchain. So 2021, fastest blockchain, fastest layer 1 block times of a major blockchain was on Solana, 400 milliseconds. And that's where Pyth had to start. It wasn't even a choice. It just had to start there because it needed to be on the fastest blockchain. If we had Pyth start on Ethereum updating, 12 seconds, the people on Solana are going to be waiting for 24, slots or whatever. So you have to start there. And so Pyth ended up first securing or providing data onto Solana and launched in September 21. Within 7 months, application builders started choosing Pyth to the extent where there were 50 applications, and it was over 90% of the market share when you count it up by the total value secured by an oracle. So the proof point was, hey, when you have this data, which we think is going to be really important, this low latency thesis, high quality, there's other solutions out there. Maybe blockchains just don't care. But if we do have this data, are people going to choose it? And so that was the proof point number 2, is within 7 months, dominant market share and has never left. And so, so then proof point number 3 is like, well, how do you go from Solana to everywhere? And this actually required a major technological upgrade. So from Pyth 1 to Pyth 2. So Pyth v2 was getting off of Solana mainnet and onto a private instance of Solana. I say private to the application, not a private blockchain. It's a public blockchain validated by the publishers in the network. You can use a Solana block explorer to investigate or to audit anything that
the
happens
first
on
SVM, right? First implementation
the
of
very
Solana
first
virtual
SVM.
machine.
Yes,
Yeah.
That's right. Yeah, now it's becoming a thing that say makers exploring. There are many others that are doing the same thing.
Some of these guys like
Eclipse,
Light Protocol. Yeah, there's quite a few now.
Exactly, and so that's what Pyth is. It created PythNet, which was the first SVM, and connected it to Wormhole, one of the most high throughput message passing bridges. Obviously, Wormhole does a lot more than that, does asset bridging as well. But this was a combination. And this is where, I'll tip the hat to what I was talking about before. If you're a derivatives DEX and you wanted to, build it, you have all these composable components. For Pyth, it was crucially important to have a partner like Wormhole available in order to have PythNet exist. If PythNet only existed without Wormhole, well, it wouldn't be connected to anything, and PythNet actually only runs one application, Pyth. It wouldn't be very useful. So a prerequisite was having mature bridges to be able to stitch this together. And so there was an architecture change at this time as well, because different blockchains have different update times and they also have different gas profiles. The change was to have protocols that want Pyth prices request them from PythNet and have them be delivered over Wormhole. This would ensure that they have the exact same source, right? So PythNet is a source for everything. PythNet's decentralized, it's fully auditable, it's fully public. You can see everything that happens on PythNet. There's 100 publishers publishing at 400 millisecond updates. There's over 350 symbols. Each one of those symbols is available to every blockchain that Pyth is connected to. And today there are over 40 blockchains that Pyth is connected to. And so this design was very different. And so it required another element of, let's see if people still want this, right? We knew that people wanted to join to be a part of the solution. We knew that people would use the solution if it was in a push model on Solana. Let's see if people are going to use this solution if it requires this new request for a price to go cross-chain. And so that only launched 11 months ago. And I'm very pleased to tell you that there have been 3 new application integrations every single week this year. There are over 200 integrations on these 40 different blockchains. And so it's a resounding yes. Protocol developers will do a new implementation for a specialized oracle that gives them a much better product. And that has been outrageously exciting to see. And we think that Pyth enables an entirely new class of applications that was never before possible.
So the data publishers publish this data to PythNet. That data is added every block time, which is very, very fast because it's 400 millisecond block times. And then you essentially propagate the data that was submitted with each block through this message bus, which is wormhole, to each of these different chains that then allows the protocols on those chains to absorb that data and use it for protocol decisions.
That's
right?
exactly right.
Okay.
And one very, yeah. And so the first thing that that people tend to ask is, well, then don't you add latency? And
That's what I was going to ask.
Oh, okay. First, so you would if you were doing it in the way you describe it. The way that Pyth actually has been developed allows you to do this without latency. So in financial markets, when you're trading over an API, when you're doing computerized trading, you have two feeds. You have your market data feed and you have your order entry feed, right? They're separate. Market data feed comes through things like Fix or a WebSocket, and your order entry usually comes through Fix. You can use that exact same model to do this on blockchains. So protocols will be watching the price on PythNet directly without any latency. And then when they choose to execute, they will request a specific timestamp. And so I'll give you an example. Synthetics is a big user of Pyth. If you're a trader on the Synthetics protocol or one of the downstreams like Quenta, Polynomial, you will be watching the price from PythNet. You click execute, the price of Bitcoin is 36,720 at T0. You click it. It says, all right, send me this T0 price, even though now we're at T5 or something. Well, not T5 because it's only going to take a second. So let's say at T1, hey, Pyth, send me back the T0 price. And Pyth will send back the T0 price. And then it settles on optimism, a second or two later with no latency on the execution. It's just a 2-second settlement latency, which, by the way, in the traditional markets takes about a day to settle. So this is a dramatic improvement. So you've actually been able to cut out all of that execution latency by borrowing a page from how the traditional markets work.
Okay, so you guys are now, well, not you guys, but the Pyth Network is launching its token quite soon. Or the claim for the airdrop has been announced, which has seemed to go out to a lot of people. There's quite frankly, one of the biggest buzzes I've seen, at least on crypto Twitter, in a long time for anything launching in crypto. I think obviously people have found this token already to be very valuable because the data providers have come on and decided to work with you guys to have some governance or holdings of these tokens. But I'd love to hear a little bit more, hear about the token, maybe about the launch, how it's working, and how it's going to work after it's been launched.
Yeah, so the airdrop is going to users of the network, right? So the right mental model for Pyth is a collective owned by the users, right? So the users are the publishers, the data providers. It's the applications that have integrated, but it's also the people who use the applications. And oracles are middleware services, right? Like they power businesses. It's like a NVIDIA or Intel Inside. You don't necessarily know as an end user that the phone that you have has a NVIDIA chip in it. And that's why I think this is such a cool thing. So the airdrop went to 90,000 wallets across almost 30 different blockchains based on the usage of applications that are powered by Pyth. In probably greater than 50% of the time, the end user has never heard of Pyth. It's like you getting an airdrop from using an iPhone because it has an NVIDIA chip. To me, that's amazing. That's so cool that you would get this. And you I have no idea, what is this? and why is Pyth giving this out to this community? Well, you're going to have some requirements that you want to have the protocol you use, and you should have a say in how it gets done. And so Pyth is a decentralized oracle, which allows the token holders to drive the direction of it. So let's say that you are a big user of synthetics and you decided that you really want to have, I don't know, let's say Bonk there, and Bonk wasn't there. You can tell that to synthetics, and they're fully decentralized governance, and they have councils, and you go to Spartan Council and say, hey, we want to list the Bonk price. And then you may get an approval. Like, actually, that's a great idea. We think we should have Bonk available to users. But if Pyth doesn't have it, well, there's not much that synthetics can do about it. So this allows users to actually go upstream and say, you know what, we want Pyth to have it because I don't want just synthetics to have it. Maybe I want to have Vela have access, or Drift to have access as well. And it all needs to come from that same source. So we're going to go directly to Pyth and be able to implement a change or request a change that enables something that we care about downstream. And so that's where the community, I think, involvement is so exciting, because we get to bring people into this network that never really thought about it. You don't get a say in NVIDIA, how NVIDIA works. Maybe you have a desire for your Apple iPhone to do something, even more advanced. If you had a say at NVIDIA, perhaps you'd be able to do so. So I think that's quite cool. The airdrop, as you say, is very wide-reaching. It's the largest usage airdrop cross-chain, I'm fairly certain, in all of history. And I say this, because of the fact that we now have developed bridges, right? This wasn't really possible 2 years ago, but because Wormhole is so good, Pyth is able to be on so many different blockchains, that there is the ability to look at this different usage. And so you can go in the airdrop.pyth.network, you put in your wallet, your EVM wallet that shows your activity on Arbitrum or Optimism. That makes you eligible potentially receive tokens for the Pyth network. They're SPL tokens. You get them via a wallet such as Backpack, where if you don't have it, you can create one gaslessly as part of the claims process. And now you have Pyth tokens, and you can go and you can put them into the governance application on Pyth Network, and you can have your vote and you can have your say about how this infrastructure is going to be run. And that's incredibly important to us. It's a piece of infrastructure that's owned by the users. It's owned by the ecosystem. And before we had two components of that ecosystem, there was the publishers and there were the application users. And now we've welcomed an entirely new group with the first almost 100,000 users. And then hopefully more will want to join the network and make their voices heard.
Why SPL instead of one of the many different chains that Pyth also services?
Well, when Pyth started on Solana, we became experts in that ecosystem and that blockchain. We've obviously had to deploy Pyth. Douro Labs has deployed a lot of the contracts on all the other blockchains. And so we evaluated the various trade-offs. Obviously, EVM has a longer history of governance, components, libraries, but there is just a lot of tools that we thought were great within, and a lot of abilities that were great within Solana, and would be perfect for the governance portal to live. And also sending messages from Solana mainnet over to PythNet was going to be seamless because PythNet stays code compliant with Solana mainnet. And having this governance application live on Solana mainnet made a lot of sense and still makes a lot of sense. I'm very happy that that was a decision that that was made. And so the token obviously needs to be native to wherever the governance portal is. And so you end up with the Pyth token as an SPL.
Yeah, I mean, I'm a huge fan of it. I think it also has something really special, which it gives you guys the opportunity to be what Mad Lads is in NFTs on Solana to fungible tokens on Solana, which is a really strong place to be in. I think Pyth has a really good chance of being there too. So I think it was a good decision. Obviously, we've been building on Solana for a long time, so it's really good to see such high quality projects deploy there. And also just the fact of like letting people participate on governance and on the different usages of the things they can do with their Pyth token and not having to spend large amounts of money for every time that they do participate is a really cool thing. So big fan of that decision. One thing I'm curious too is like you guys are servicing so many blockchains now. You're actually dominating across a lot of these blockchains, if not most of them, obviously outside of a couple, but for the most part, Pyth is sort of this incredible presence. I think it's, has like 1.3 billion of Oracle TVL at the moment, maybe a little bit more. How are you guys thinking about expansion, focus? I imagine it must be hard. There's so many new blockchains and L2s and L3s and all of these things coming out of the weeds. How do you guys sort of dedicate resources or coordinate with the foundation side to dedicate resources to where the building should be happening?
Yeah, I mean, when I look back, I can't even believe that there's been 40 new blockchains added in 11 months, because there is a lot of work that goes into all this. And it has paid off, though. So as you say, Pyth is dominant on a lot of blockchains. I'll give you some numbers on it. On over half of them, Pyth has over 50% market share. And on a third of them, Pyth has over 90% market share. These are important things to do if you want to establish yourself as the preeminent, best financial or market data oracle in the world. And that's how Pyth has positioned itself. And it seems like in areas where there's fast blockchains and Pyth can really highlight its attributes, those are where the market share really kind of shows itself. Where Pyth is still new, right? So some of the blockchains maybe is just deployed on, or ones that are really old, like for instance, Ethereum mainnet, it will take some time before Pyth's market share really kind of meaningfully improves, because you don't yet get the ability to showcase this high throughput on things like optimism layer 2s. Like, yeah, sure, that's somewhere where Pyth is able to really kind of showcase things. We realized that going to market incredibly quickly in this modular fashion would allow the world to be able to use Pyth and then become aware of Pyth very quickly. And it's becoming very much the standard for high throughput DeFi. We have to imagine that will continue, and it will continue based on the opportunities that are out there and the excitement. This is cool because it goes now to the community. And so if you have a new L1, L2, L3, or some sort of a roll-up as a service, you can actually go to the governance and propose a deployment, and that's how things will be run going forward. And that's another element that it really excites me, is that there's tons of demand. It's been difficult to manage kind of pre-governance, but post-governance, people will see how much activity has been going on in the Pyth network. This I can't understate. There's 100 publishers. These are like the biggest financial firms in the world, and they are sending millions of transactions to PythNet blockchain. There's over 300 million transactions on PythNet every single day because of all of these updates. When you think about institutional adoption and the trial of various things that are highly experimental phases, or discussions that people have about things that could happen in the future, et cetera, et cetera. This is actually happening today and has been happening for years now. So Pyth has had institutions, the biggest financial institutions in the world, daily active participants, sending in transactions, involved in the blockchain for years. And that's huge. And at the crossroads of this, Pyth is providing data to every blockchain. You can think about it as like electricity powering cities. And there are just so many cities that are being powered, and Pyth is sitting at the cross chains of it. And you can imagine the dialogue that happens from all of the product protocols that use Pyth, all of the data providers and publishers, and now what we have with the community or with new blockchains. It's incredibly huge discourse. And so people will start to see how powerful of an application Pyth has been for a really long time, and will continue to hopefully only grow from there.
Yeah, I think that's very right from a few different, from the side of folks feeling like a shareholder to some degree and feeling like they need to voice their participation to the world and having an incentive to do so, as well as also folks having to participate with all these shareholders if they want Pyth to be there for them, for their chains, for their app specific rollups, for whatever it is that they're building. So I think that's pretty exciting. What do you really want to see happen here? What is an ideal outcome of your, Pythian world in 3 years, even though 3 years is hard in crypto? But if you had to state a goal, a mission statement here, what would that be?
Oh yeah, it's tricky because there's very ambitious ones, and also I'm thankfully now just a community member, so we'll have to convince the community. But I'll tell you, I've thought about this a lot, and I like the analogy of Spotify because of what it's done, right? So all of the world's music flows through Spotify, and I think all the world's financial data should flow through Pyth at some point. And the reason why I like that is because if you have a farmer in Kenya, prior to Spotify, they were potentially limited by their record store on what music they could potentially buy and listen to. And they were certainly limited by their budget, right? You can only buy so many CDs. Spotify gave an incredible user product to the entire world, where you get the full library and you can go anywhere in the world. You travel with it, always with you. And I have aspirations for Pyth to do the same thing, to power applications that provide people in Argentina or Kenya with access to financial products that are built by DeFi builders, application builders, and not having any limitations with regards to getting them the best data to be able to build those applications. So that's like the table stakes for me. It needs to be, all the world's financial data should flow through Pyth, like all the world's music flows through Spotify. And then if I were to speculate on what could be next for Pyth, Pyth does an incredible job of being able to incentivize data owners to make their data available on public blockchains, right? So the data to Sigma or Jane Street or Susquehanna is all proprietary to them. If they didn't publish it to PythNet, it would remain proprietary to them. It would be only their data. But because Pyth has incentivized them to make it available, the world now has this effective Spotify. That model would work in other things. There are other types of data that aren't yet public, or not public in the most valuable part of it, effectively close to T0, that could be incentivized to be brought into the world of blockchains through a similar model. Now, I won't speculate on what they are, but just suffice it to say, there are certainly opportunities where different types of data that has real high value. I'm not talking about just getting weather data that's fully open sourced. I don't think that's particularly interesting. I think it's more around getting highly valuable data that's been provenly valuable, so it's valuable off-chain, and bringing that on-chain in a way where the owners feel like it's a worthwhile thing to do.
And on a more personal level, you've gone from being at many of these different places that were market participants in different markets, different market structures. You've sort of optimized to understand these different market structures, but now you've just been leading a really large team, many different components, very engineering heavy. It's a huge shift, and I'd love to hear a little bit about how that's been for you, and if there's anything that's really stood out for you on that experience. I know you've managed large teams before, but what it feels like to sort of run a group like you are now.
Yeah, well, you're probably giving me more credit than I deserve. So I have co-founders, and Jan Krishnamurthy is a brilliant CTO who has got a incredibly impressive background, MIT PhD in machine learning from Carnegie Mellon, sold a AI company before AI was cool to Microsoft before getting involved in Pyth. So he is a technical brain that I've never seen, like I've never seen before. So that makes it a little bit easier.
I can relate.
We have, yeah, exactly. And then we've got Kieran Cronin, who's the COO and co-founder of Douro Labs as well. He was the head of treasury at Jump, and so that's no small task. And so he brings an incredible wealth of professionalism to financial and organizational side of things. So it's really, at the end of the day, it's about building great teams. And I've been able to focus on the business side of things and make sure that team is excellent. We have an office here in Porto where a lot of us are sat. There's 10 people on the team here. And we like coming to the office. No one's required to. And we find it to be a challenging, competitive, and exciting environment. And I think that sort of ethos, which I've really learned from systematic trading or high frequency trading firms, the reason why they're so good is they constantly push themselves and innovate. And you tend to have to do that in person. And that's really the philosophy we have. We just really love doing this. People are incredibly passionate about it. And that's how we want to push ourselves. Like we're never really satisfied with what we have. And as soon as it looks like there's some level of success, we want to find something, bigger to do with it. So I think those are the things that we sort of focus on. And of course, along the way, as you get older, you just learn so many different things and get exposure to it. So while I considered myself an expert within the financial markets for years, now I have a very good understanding of how to set up a company, lots of things within HR, understanding some of the regulatory nuances of operating the space that we operate in, and all kinds of things. And I think the attitude is just assume that you constantly need to be learning, and as soon as you figure out something that you're really an idiot on, that's where you should sink your teeth into.
And my last question for you, Mike, is: are there any personal lessons or habits that you feel have helped you throughout your career? Maybe picked up recently, maybe a long time ago, but anything that's been really impactful for you?
Oh man, you said it to me on our first podcast. And I had I had this almost the same answer because I still use it. So there's this book, The 7 Habits of Highly Effective People. I've read tons of these sort of productivity books, but I think this is by far the best one. And like, there's this framing where it's like you picture yourself at your eulogy, you've died, someone's talking about, what sort of a person you were, and you have to envision what do you want them to have said about you. I think what that does, it allows you to teleport into the future. Like, you don't have to be at your death, but you could just be a year later, and you're just reflecting back on, the roles that you've taken on. So the way that I apply that to my life is I actually write out my objectives on a weekly basis based on roles that I like to have. So I obviously have work, and it's easy to roll everything into work for me because I'm from New York and worked in finance for a long time. But I'm also a father and going to become a father of another little girl soon. So that's an important role. And I'm a husband, and I'm part of my community here in Porto. So I have to make sure I fill out all those things as well. So finding balance and feeling like I've had success in a variety of areas has been very rewarding for me. And it's something that I found only a few years ago, this particular implementation strategy, but I highly recommend it.
Amazing. Well, thanks for sharing. Congrats on everything that's been happening recently, and thanks for coming on the pod.
It's been a pleasure. Thanks so much, Tristan.